Hello, everyone. Today on the final bar, I'm joined by Ryan Detrick from LPL Financial. We'll talk about this overall market environment, particularly the leadership that we've seen from some of the cyclical sectors, energy, materials. Even though the market's down pretty significantly today, those remaining at the top of the list, particularly energy, right? So losing the least, even when everything's sort of down. The S&P, the Nasdaq, really giving up a lot of the previous gains. The S&P coming off a fairly elevated level, trading right around 4,500. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com and at cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we debrief on the markets using the power of stock charts, using data visualization techniques to better understand investor behavior, to focus on the message the markets provide back to us in the form of price and trend, momentum, breadth, sentiment, all those different indicators we can use to try to understand what's happening here. We talked about the S&P sort of being in this choppy sideways phase for a little while ago, right? On a longer time frame, you know, the S&P has sort of revolved in a range, 4,300 on the lower end, 47 to 4,800 on the upper end. But now we've settled into sort of a range within a range. Yesterday, we pushed up toward the upper end of that, getting up to around 45.80, 45.90 on the S&P. Today, right back down. Yesterday's close, sort of today's high. We spent much of the afternoon sort of rotating lower. A little bit of a bounce into the close, but the S&P finishing, right around 4,500. That's down almost 2% from yesterday. So this is a market that I would argue frustrates everyone. If you're bullish, days like this are a kick that make you question your sanity. If you're bearish, days like this are frequent enough. You're still not, coming off of a pretty heavily off of previous lows. So no one's happy at this moment, but we'll see what some of the longer term charts can tell us. We have great guests on the show every time we bring them on. I'm excited to talk to Ryan Detrick again here in a few moments. Next week, we have a couple really good guests for you. On Tuesday, the 15th, we have Jay Soloff from Investors Alley. On Wednesday, Sean McLaughlin, Chief Option Strategist at All Star Charts. So it'll be an option-themed day for some of our guests next week. I'm going to be off Thursday and Friday of next week, traveling out of town to visit some family. And next Thursday, Julius DeKempener from RRG Research graciously accepted our invitation to guest host this show. So he'll be driving on Thursday, the 17th. Let's continue on to our market recap. Today's sponsored by Chaikin Analytics. If you go to Stock Charts ACP in the bottom right corner, you'll see a little plug icon. The Chaikin Analytics plugin featuring the Chaikin Power Gauge is available to you right there. Looking at the markets today, as I mentioned, we're sort of in that range within a range. We'll look at a chart of the S&P 500 here in a few moments, but just to check in on what happened going into the close. The S&P down about 1.8%, got below 4,500, but by the close had bounced just right above there. The NASDAQ 100 down a little further, with the NASDAQ 100 down 2.3%. The VIX bouncing back higher, come all the way down to around 20, now bouncing back up to finish today around 24. Mid caps and small caps both down, but not as much as the S&P 500. If you look at the sectors here in a moment, you'll see probably why that is. Things like financials and others that are a little heavier weighted in mid and small cap indexes we're able to keep those indexes not a little bit higher than they would have been otherwise. Interest rates pushing higher today, and some of the comments from the Fed governors really pushing things to the upside. 10-year yields continuing to push higher. We've talked for a while. Hopefully that is not a surprise, because we've been talking for months and months about the prospect of higher rates and what that might mean, what types of sectors tend to do well, what tend to struggle given a rising rate environment. Now we're really starting to see those that uptrend in rates materialize. The 10-year yield getting up to around 203 here at the close. The dollar index pretty much holding steady if you use the UUP from yesterday's close. A lot of commodities roll over, and I was talking to someone just before the show about gold prices and what you would expect, given the fact that the market is down so much. that gold would be rallying, and it's actually not. It's not played out that way, and not just today. That's actually been a challenge for gold for quite some time. People think of gold as a safe haven, and if you look at times in market history, that's definitely been the case. Not today. So you have the S&P, the Nasdaq down fairly significantly. Gold price is really not rallying. It's not like people flock to gold. They're somewhere else today because the GLD down just over 1/3%. Silver prices down as well. Cryptocurrencies really feeling the pain here at the toward the end of the day. Bitcoin prices had been positive, sort of that day when Bitcoin was up, Ether was down. They all sort of rotated to the downside. Bitcoin's right around 44,000, and that's coming off of being above almost to 46,000 not too long ago, earlier today. Ether actually came down. It spent time around yesterday's close, but selling off and at the lows of the last 24 hours, currently around 3,100. Let's look at a chart of the S&P 500. We'll come and check in on some of these other charts. So, we talked about what I've called a range within a range. If you look at the trend in the S&P over the last 4 or 5 months, we really haven't gone anywhere. We're currently at the same levels the S&P was back in September of last year. Now, having said that, it has been an exciting period, and there are stocks over that time frame that have ripped to the upside. And I'm looking at energy and others that are up double-digit percentages just in the first 6 weeks of the 5-6 weeks of the year. You have other sectors, obviously, like communication services and others that are really struggling, more broadly speaking. But that nets out to an S&P that really has been sideways, right? We've fluctuated quite a bit. And if you look 42 to 4,300 on the lower end, 47 to 4,800, that's sort of the range, the larger range that I would say we're in. So there's been a change of character, I would say, on this chart from beginning mid 2021 to sort of toward the end of 2022. And even though the indexes went higher, it was really more of a sideways market, only because a lot of individual stocks had really started to rotate lower starting in November and then December. Now, however, on a tactical time frame, I would say we've settled into a range within that range. So now we have on the shorter term 45.90 to 46.10. That's the Fibonacci resistance that we hit last week, and it's also the 50-day moving average. On the downside, you have the 200-day moving average, which is almost right at Fibonacci support around 44.50. So what's interesting about this market is we're chopping around over the last 2 weeks right within those extremes, and at some point, we stop going sideways and one side tends to take more control. Either the buying power can come in and push us beyond the previous resistance and overwhelms any need to of investors to sell. And it started to look like that was forming yesterday, but today, obviously, giving back all of yesterday's gains and even double that, pushing down into to 4,500. On the downside, we break below 44.50, and all of a sudden that tells you that the buying power that we've seen come in, those days that have moved higher, aren't enough to overcome the bearishness that we've seen from some of the sentiment data. And it tells you that we're more likely going to go and retest some of the previous lows. So I think this week is a key decision point in terms of which way we go next. And I think this is a really important time to be watching the chart of the S&P to see which way that breaks. And I think whichever way we break out of that short-term range, I wouldn't be surprised if that's the next leg we would be anticipating. If you ask me which one of those is more likely, I would say, based on the data I'm seeing, the break lower is much more likely than the break higher, just given the deterioration we've seen in breadth and sentiment and other readings. But we'll have to see. The price will tell us which way the market is breaking when it actually follows through. Looking at sectors today, materials and energy sort of jumping around at the top of the list, but both of them down about 0.5 to 2/3% or so. The financial sector next, and then consumer staples, all of those down though, right? So nothing finished today in the green. Everything was in the red. On the bottom of this list, we have some defensive sectors like real estate and utilities, but also technology in there as well. And two of these are pretty big sectors: technology, consumer discretionary, more growth oriented, finishing to the downside. It's sort of a weird day if you look at the sector distribution. If you told me that the S&P and the Nasdaq were going to be down about 2%, and what kind of did well, my assumption would be it's going to be more value-oriented stuff and most likely more defensive stuff that would probably be at the top because people were kind of rotating into those things. But you're really not seeing that. Utilities, real estate down fairly significantly, along with tech and consumer. So it's probably a good reminder to think less about what should work or what could work and focus on what actually is happening. The charts, I would argue, will tell you where the momentum is shifting and will tell you what themes and what stocks are starting to emerge in positions of strength. We don't have a lot of time in today's show to dig into individual stocks, so I did want to touch on just a couple of those. We'll start with Disney. Disney, obviously, in the headlines today, reported earnings after the close yesterday, and and again, I'm not a fundamental analyst, but my 5 second summary is pretty decent quarter, and it's the streaming services, but it's also the parks, which are actually starting to show some real signs of life, showing emerging from this pandemic era and starting to see some positive numbers there. All of that is very encouraging. What's interesting from a technical perspective, though, is if you start where we're at, look at the final bar and look to the left, 160, a really key level. So I was asked after the close yesterday, as the numbers are coming out, what do we do now? And I sort of looked left and I said, all right, who knows what's going to happen tomorrow, but I would be really keyed on 160. If Disney could get above 160, that tells you buyers are believing enough of what we're hearing from the company that we think that there's further upside potential to be had. If we are unable to get above 160, though, that this is still a chart in a downtrend of lower highs and lower lows. And what's interesting today, we gapped higher, which makes sense after a good report. We didn't even get up to 160. We actually closed below the open and sold off through the course of the day. Now, it's not 100% fair because this is a day when there was a lot of distribution, so sort of a more of a negative feel to the tape overall. However, I would say with a chart like this, don't get too excited about the fundamental thesis unless you see the charts actually recognizing the upside potential. I think on something like Disney, it needs to get to new swing highs, it needs to make a higher low. Those are the things that would make me more optimistic. You need to get above 160. The RSI would need to improve from there as well, I would argue. We need to take a quick commercial break. We'll be back with today's guest, Ryan Detrick. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down the market activity using a lot of charts. A couple quick comments before we get to today's guest, Ryan Detrick. First off, we have a mailbag segment a couple times a week. We'll do another one on tomorrow's show, Friday of this week. We'd love to answer your question live on the air. You can get your questions to us three ways: via email, thefinalbar@stockcharts.com, via Twitter @FinalBarSCTV, via YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. We'll hope to answer one of yours on the air on tomorrow's show. Also, go to StockChartsTV.com. That's our on-demand platform. Great guests like Ryan Detrick and many others sharing their expertise. Special events like The Pitch, our market outlook specials from Larry Williams, Martin Pring, Tony Dwyer, Gina Martin Adams, so many really knowledgeable experts sharing their take on where things may be headed. All of that for free on our on-demand platform. Go to StockChartsTV.com, or on your mobile device, just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Ryan Detrick. Ryan is the Chief Market Strategist at LPL Financial. Always does a great job of helping us put things into proper long-term context. Ryan, welcome back. Good to see you.
Dave, thank you for having me back. Appreciate it.
So we're starting looking at energy on a down day. You had sectors like energy holding up pretty well, but there's been certainly a story year to date of incredible strength from the energy sector. How are you seeing this sector over time?
Yeah, Dave, wasn't just this year, right? Last year, energy stocks were up over 50%. January, out of the 11 S&P 500 sectors, only one was green in January. That was energy, up almost 20%. So clearly it's had a big run. At LPL Research, what we're telling our nearly 20,000 advisors is we've been pretty optimistic energy here for a while now. And I think the chart I'm showing, it's energy versus consumer discretionary. And you can see here for 14 years, it went down. What's that tell us, right? Consumer discretionary did better than energy. And now all of a sudden we're starting to see some pretty major technical improvement. I think what your average person listening, investors need to know, there could be a lot of continued relative strength in energy. Now, we'll be honest, energy is about as far above its 200-day moving average has ever been. RSIs are overbought, all that stuff, okay? You could have a well-deserved pullback or correction in energy any second, literally. But I think historically, when you see changes in trend, you get these astronomically overbought scenarios. And we saw that, off the lows in 2020 in the market in general. We're like the furthest above the 20-day moving average of all time back in like March of 2020, early April of 2020. And sure enough, that was bullish, right? That was a change in trend. So that's kind of where we see it. There's lots of ways you can look at it, but it's just one of them. Energy to us still as a group, we think you should be at least even weight, maybe a tad overweight in your portfolios. And the last thing I'll say, Dave, we like to buy scarcity, right? Well, energy is pretty scarce. It's still like less than 3% of the S&P 500. I believe the most recent data, 22 energy names in the entire S&P 500. So that's something else. It's a tailwind, we think, for this group to probably continue to do pretty well, not just this year, but maybe several more years down the road.
It's so funny, Ryan. I love this long-term chart. I remember years ago, energy was just such a. I mean, if those of us that have followed weightings in the
Yeah.
S&P, energy used to be a much bigger deal when you're
Oh
thinking
yeah.
about just the overall movements of the market. It's obviously gotten smaller and smaller. You alluded to the challenges of what's happened right now, and what I love about this long-term chart is it puts this recent uptrend in context. So a lot of people looking at names now are seeing charts that are just going up and to the right, and it feels like you've missed it. So can you
Mhm.
just help us understand, how do you relate the short term to the long term, right? How do you deal with the long term strength? And is it waiting for a pullback? Is it waiting for some macro change that would allow you to
Mhm.
get in at a different point? How do you sort of think about that and connect that to this long term rotation we might be seeing?
Absolutely. Well, with the models that we run for our advisors, we're kind of waiting, right? We're waiting for some type of pullback. The move in energy stocks, we've seen a 10, 20% pullback. Very likely it's going to feel uncomfortable when it happens, but that'd be perfectly normal with the move that we've seen. So we're willing to be
Hmm.
patient. And one more thing, Dave, like at the low, like you can look on that chart there, literally at the low. You guys remember what happened? Little company called ExxonMobil got kicked out of the Dow after 94 years in the Dow. I remember when that happened.
Yeah.
I said, wow, this could be the time. Remember, energy went negative, then Exxon got kicked out. I said, this could be the ultimate contrarian indicator that energy is a place you want to be, not just for a year or two. We're talking like maybe a decade or more when you kick out Exxon. And it's incredible. Literally, with like within 2 weeks of that happening, boom, that was the low in relative strength and energy. And it's been the champ ever since. It's funny how that happens.
It's been working beautifully since then. Now, your second chart, a little levity here. We have the Super
Yeah.
Bowl indicator. This is something looking at Super Bowl history. Tell us what this tells you about the current market.
Yeah, well, first off, disclaimer, right? Don't invest on who wins the Super Bowl, but it's as week of the Super Bowl, so we'll have some fun with it. This was discovered in 1978 by a New York Times author, and at the time, it always had worked. If it's an original NFC team that wins, the stock market is up, and if it's an AFC team that wins, the stock market usually doesn't do very well. Now, we did a broader look at it, Dave, and just broke it down NFC, AFC, right? This is the 56th Super Bowl. If the NFC wins, the market's higher for the year like 79% of the time versus about two-thirds of the time AFC, and returns are stronger for the NFC. So just be aware of that. Now I am a Bengals fan, so I said I can't put up with that. I got to find a reason to root for my Bengals in the game on Sunday, along with the stock market. 10 of the last 11 years, as we're showing on the screen, when the AFC is won, the the S&P is actually higher. Of course, it's totally random, but it's kind of fun. And the only time it didn't work was in 2015 when the Seahawks decided to, try to get the MVP for their quarterback throwing the ball, and he throws the ball right to the wrong team against the Patriots. That's almost like an asterisk by itself, right? So all the other times the AFC has won, stock market did well. So as a Bengal fan, I hope it both continue. The bull market and Joe Burrow puts a ring on his finger soon.
I love it, and it pains me as a Browns fan to say good luck to your Bengals, Ryan. But I
I
say
get it.
that sincerely. I hope things go well. We only have about 30 seconds left, but I love it. We talked about the S&P 500 in our market recap. Obviously, sort of in this range within a range. Do you have a broader sense of are the lows in for the foreseeable future? That low we bounced off of 42.50 or so, or do you see further downside for stocks given the environment we're in here?
Yeah, we think we maybe go down to test those lows. Right, a couple of Mondays ago, that sure felt like capitulation. Right, record volume, record put to call ratios, outflows, just the friend indicator. Right, random friends texting you never hear from. So that's kind of how those flush lows happen. Maybe we go down and retest it. Maybe by a tad break it just to kind of you get some real fear. But we're optimistic that we're trying to carve out a bottom. I mean, after the run we had last year, Dave, of only 5% correction all year. Do not forget, it's a midterm year. Your average midterm year sees a 17% peak to trough correction, right? It's just kind of one of those things that happen. Midterm years aren't easy. They're choppy. They're volatile. Usually
Mm.
late in the years when the bulls take over. So we think we're trying to form a bottom, and just be aware, midterm years are rough.
Ryan, good luck to you this weekend. Enjoy the game. Thanks for coming on the show, and take care.
OH, Dave, anytime.
IO,
There
Ryan
we go.
Detrick from LPL Financial joining us. And I love that first chart, thinking about the relative strength of energy versus consumer. I've shared longer term ratios at times, things like financials versus technology. Just thinking about these relationships, and the chart of the financials versus technology doesn't look too different from the one that Ryan was sharing there. A lot of these value oriented sectors have been underperforming the growth oriented sectors for so long. It has become, I think, for a lot of investors, sort of just a market truism. This is just always going to be the case. I think what we're seeing now is some of those rules that you learned as you were investing might be changing. And the best thing about charts is they tell you when the game is evolving, right? They tell you when the trends are shifting. Really good time to pay attention to long term trends, and particularly where the strength is emerging. Great take there from Ryan Detrick from LPL Financial. We need to continue on with our next segment, getting sentimental. We'd like to check in on the weekly sentiment data. Wednesday into Thursdays, when a lot of this weekly data gets updated. It's a great way to understand. The price tells us how investors are voting with their capital. A lot of the sentiment data is also related to that. Some of this is based on options data, so you are getting a sense of flows a little bit, but also some of the survey data, which tells you how people are voting with their mouths, right, with their votes. What are they telling you about their take on the market? Some interesting takeaways, hopefully, here as we go through these sentiment charts. First one, we're going to start with the VIX. This is a measure of, obviously, of volatility. It's based on options market on the S&P 500, but overall is tended to be thought of as the fear gauge. I don't really like that name, however, because I think it implies more of an inverse relationship that is consistent. And while a lot of times you will find an inverse relationship, right? When the markets go higher, there tends to be less volatility. When the markets sell off, there tends to be an increase in volatility, but it's not always been the case. And right in the middle of this chart, you'll see one of those examples, right? August of 2020, you saw the market moving higher, you saw volatility increase. So you can't really use the VIX as a inverse indicator on the S&P. However, certainly gives you a measure of uncertainty, and that's probably what I would tell you is maybe a better way of describing it. Fear is okay. I think uncertainty is maybe a better way of picturing this indicator. So when we talk about how the markets have evolved from November to now, when we talk about breadth indicators starting to roll over with the advanced decline lines and percent of stocks above their moving averages, when we talk about the momentum divergences with the S&P going higher in November, December, January, and the momentum, the RSI on the S&P 500 actually sloping downwards over that time, the look at the VIX helps you understand how that has actually evolved, right? How that change of character has occurred. If you look at November, early November, when I would argue the market kind of topped out by most definitions that I would follow, the VIX is down all the way to 15. A couple times already in the next 3 months, the VIX has spiked above 20 and even well above 25, even 30. We've gone above 30 a couple times here in early December of last year, and then again in late January of this year. And so far, those have been sort of the bounces that we've seen. Those have been the tradable lows so far in the market. So it's worth noting, number one, the fact that volatility overall has been elevated. Look at the last 3 months of the VIX versus the previous 6 months, and you can see how things are changing. We're not getting down to 15 anymore, and we're spiking well above 20 and 25. I'd mentioned in a market outlook discussion early in January, I think the VIX will spend more time above 20 than below. And I stand by that for now because you're seeing elevated uncertainty. And I would argue, given what we're hearing from the Fed, days like today, when comments related to interest rate hikes are kind of shocking the market a little bit, I don't see that changing anytime soon. I think until Fed rate hikes become a reality and the market is able to digest those and understand what happens to stocks, because it's been quite a while since we faced that sort of stretch, I think volatility and uncertainty will remain elevated. So I would be looking for when the VIX gets above 25 and especially 30, because that's become sort of the new short-term bounce level for the VIX. Looking at the AAII survey, this is surveying individual investors every week, and they're asked, are you bullish, bearish, or neutral on stocks for the next 6 months, if I remember right? And in general, it's been an interesting way of understanding individual investors. And again, granted, it's a small number of individual investors that are responding to this survey every week. But what's cool about it is it's been running for so long. You can get some great deep history and look at how the indicator has performed around major tops and bottoms. Look at just how this whole shift has occurred over the last 8 months, where these bars, the green bars represent the bullish respondents, the red bars represent the bearish respondents. Back here in April of last year, almost a year ago, we had almost 60% bullish and we had about 20% bearish. couple weeks ago, that almost had retraced back to the opposite vote, where bears far outweighing bulls, bulls only around 20%, while bears well above 50%. Now we've sort of settled back into a pretty consistent level, and the bear, what's different is it's a similar level of bullishness, around 24-25%, but the bears have been declining. So what that tells you is over the last couple of weeks, the respondents have gone from bearish to neutral, but not really going from neutral to bullish, is how I would probably think of that, which means the extreme bearishness has alleviated, but you're not really getting people excited about market upside just yet. And you can see it's still an 11% swing from bears over bulls at this point. The name exposure index is looking at active investment managers and what allocation they have to equities. And they can say 100 or 200% long, 100 or 200% short, or 0% equity. And where this nets out today is around 67% long. Last 2-3 weeks, it's actually been around 50 to 60%. So we've jumped up a little bit, but still relatively low compared to where we've been when the market's obviously been in a strong uptrend. I have this blue horizontal line showing you where we're at relative to the range, and probably, to be honest with you, if you look at this longer history over the last 6 or 7 years, pretty much right at the midpoint of where we've been. So it's not extreme bearish readings like we saw here when the market really sold off into the March lows. It's more like we were, in sort of the middle, when we're during brief pullbacks that haven't gotten that bad yet. And so I think it's worth noting, worth following this to see if you see continued increase or decrease in that rating. Just to finish off the put call ratios, we have the equity only and the total put call ratios. I would say both of these have come off a little bit. The pink line that you're looking at is a smoothed out version. It's basically a 5-day moving average because it's a daily series that gets pretty noisy. So in gray in the background, you can see the raw data. I'm looking at a 5-day average of that just to smooth out the series a little bit. And here you can see, as the market's been rallying a little bit, that put call ratio has come off. It had spiked up. The 5-day average was at the highest it had been since the March 2020 pullback. So very interesting to see. It's getting near sort of that the previous highs that we've seen. But worth seeing if that remains elevated, which would again tell you sort of increased or continued bearish positioning, indicating potential market pop from there. We need to wrap that segment and wrap the show. The 3 in 3, 3 charts in 3 minutes. Here we go. Chart number one is just a daily chart of the S&P 500. When I'm looking at this chart, it strikes me that we're literally just the same place we were at the beginning of September. Now, there's been a wide range of activity from the market itself, looking at the range we've been in, but also from individual stocks and sectors, some of which have been up significantly, like energy, as my guest Ryan Detrick was talking about. Others down significantly. Cannabis stocks, which we'll talk about in a moment here, down fairly consistently over that time period as well. And that nets out to the S&P sort of in the middle, kind of chopping around that range. And now we've settled into a range within a range. Yesterday, we looked at this chart and talked about that 45.90 level, that Fibonacci retracement level. We hit there. We almost closed right at it. And I mentioned, can we get above that level? Can we push higher? That's the sign. We didn't get it. You got the opposite today with the market selling off from resistance. A market bouncing off of support and selling off of resistance is a range-bound market. I think that's where we're at right now. Chart number 2 is Disney. I'm very interested to see how the market reacts or market performs or stock performs leading up to an earnings announcement and coming after an earnings announcement. Guys like Tom Bowley at Earnings Beats, longtime StockCharts contributor, do a great job of talking in a lot of detail about how to think about stocks and how they trade around earnings dates. What I would tell you is it's a great time to look to the left on the chart and see where we're at relative to where we've been. Earnings have the tendency to make stocks pop to the upside or downside. There's a company-specific risk that happens where a good or a negative earnings release can certainly move the market very quickly. Most gaps you see, or many gaps you see on the chart of an equity, are due to earnings or earnings-related information. But what happens, though, is what happens after the initial shock of that change plays out. And now we see Disney gapped up to above 155, 156, but trading down through the course of the day. Finished up about 3.3% from yesterday's close, but trading down through the course of the day and unable to get above previous resistance. I would get interested in a chart like this if the price can get above its previous swing high, get above 160. If the RSI can get above 60 as well, that's where we peaked out in early January. That's more of a bear market configuration. You want to see it push above on a price and momentum basis. Finally, cannabis stocks. I did a session for the Money Show with Greg Schnell earlier this week about cannabis. We looked at the MJ bouncing over the last couple days. Can it hold the 50-day? It's an interesting chart to watch. We need to wrap the show here. A special thank you to Ryan Detrick from LPL Financial joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.